Hey, buddy, boys, this is BK Force. Welcome to our weekly Where Are the Trades edition for March 2nd through the March 6th of 2015. Let's take a look at the charts, see what's really been going on. It's been really an interesting week because it sort of started out very calm, very flat. Really thought maybe the euro had a chance to kind of begin a short covering squeeze rally. And then Thursday, we had a massive move to the downside, mainly triggered by the idea that the CPI numbers were hotter, that the data now is starting to really flash the possibility that the Fed should begin tightening its monetary policy starting June instead of September. And it was a big crash of stop loss orders that pushed us all the way down into the 111 handle before it finally found a little bit of support. And today, basically, it's just been struggling around this 112, up and down around it. The chart really looks possibly negative for the euro. I mean, the one last hope here for the hold is this 110 bottom, and it is a very strong bottom. It was a spike bottom. We kind of consolidated around here, but it's an interesting point here because we have the U.S. data coming up this week that could sort of be the nail in the coffin to the weak dollar argument. If we have another very strong employment number and followed by strong wage growth, which has been the key. This was the really key thing that happened in the CPI data that pushed the euro over the edge. It was the growth in wages that is the final sort of trigger that everybody thinks will be necessary for the Fed to begin tightening policy. On the other hand, all of the flash data, like the Chicago PMI data today, we're going to have the ISM data before we have the NFP data, is not exactly uber bullish. I mean, part of it could be explained, I guess, by the fact that we have just massively cold weather spell in the Northeast and the Midwest. And maybe it's all weather related. And maybe none of this is just demand related, but is simply a freak of nature kind of a thing. But still, that is the one troubling, nagging point, is that while jobs are starting to pick up, production, demand, all sorts of the underpinnings of the U.S. economy are not, and that could be one of the things that could be holding the Fed back. So this is the reason why you see on the chart here this kind of not very clear indetermination as to whether the euro really is on its way to breaking the 110 level moving further. I mean, from a chart point of view, of course, you have this massive decline. You have this long consolidation here for pretty much the month of February. Generally, when you have such long bases, the move one way or the other is pretty definitive. So we are closer, obviously, to the move to the downside, but we haven't really tested the move to the downside. And really, I think the move to the downside doesn't come into play until the 110 gets broken. All of this is just simply a preamble to a test at a double bottom. And in many ways, if you do think it's a double bottom, it actually presents, of course, an incredible buying opportunity around these levels because you're essentially buying at the lower end of the range. So until the 110 is broken, I think the jury still may have to go to a bargain hunting trade for the euro, but it is definitely getting much more threatening to the euro on the long side. Conversely, the yen looks quite good. Today we had the better than expected GDP, slower than a quarter prior, but above 2%, enough to really provide a little bit of momentum. The really big thing here, of course, is if you look, this is kind of interesting, deja vu all over again. We broke the 120 off last month's NFPs and really spent, it's really astounding, I didn't even realize this, we spent the whole month essentially consolidating 120, 118. That's been the story since last month's NFPs. And I think that is, in many ways, really going to be telling, because this month, if we get a second better than expected number with strong wage growth, could be the month that really breaks the camel's, the straw that breaks the camel's back, and we push ourselves higher and possibly go towards the test of the yearly highs and the multi-year highs here around 121. If it is negative, then actually I think it's quite interesting, because then it sets us up for a much more negative construct. Because the thing about the yen that's just very tough to gauge at this point is you have a series of lower highs over here and a series of higher lows. So you have this volatility squeeze that needs to resolve itself one way or the other. Now, if we resolve ourselves to the downside, and more importantly, this is really, I think, going to be very negative technically. If we break the 118, that would now set a series it would break the whole series of higher lows and effectively create this lower highs as the dominant trend and push us perhaps all the way down towards a retest of the 116s. So quite a lot of interesting possible formulations as the week develops. The pound, much less interesting. I mean, we will have UK data. It'll be one of the interesting thing about the UK data this week, the PMIs are going to be running out, is whether it is indeed the second to hike. That's really been the strength of the pound. That's what you're seeing here is the sort of, this big recovery has been the theme of the second to hike, meaning that the BOE is going to be the second one after the Fed to go hiking. And as a result of this, by the way, we've had just massive downward moves in the euro pound. Really, really strong move to the downside off the 75s with really no stop in sight. We're at 72.47 and that continues to go. This kind of a trend could have 70 in its target if the trend accelerates. In fact, it could be very interesting next week because if we get sort of strong UK data, strong US data, the euro continues to be a laggard. This is going to favor euro pounds to the downside as the pound is not going to drop nearly as much as the euro against the dollar. Looking at the COM dollars here, let's just actually start with dollar CAD and the COM dollars. So dollar CAD finally starting to calm down. Oil definitely starting to stabilize around the $50 a barrel point. And until essentially, as long as we're 45.55 in oil, we're basically holding the highs in dollar CAD to the 128s. The other thing that I think is interesting is that the monetary voice out of the BOC has gotten decidedly less dovish. They basically said, hey, we made this rate cut because we want it to be preemptive. We think it achieved what we needed to achieve, and this isn't going to be any kind of a start of a long QE loosening process. And so that, I think, also is supportive of dollar CAD to the downside or of loonie to the upside. We still remain a series of lower highs here that operates against the 26s. And unless we get a markedly lower oil or sort of this sort of blowout U.S. number that could just take the dollar against everybody to the highs, I still think even if you have a strong U.S. dollar to the highs, it's going to find a lot more resistance at the 128s, especially if oil doesn't cooperate. If oil remains effectively in the 45-55 range, it doesn't go down any further. That's really the big story here, and that's what needs to be watched as we go forward. Now, Aussie, another interesting trade because it's having this very interesting, trying to have this very interesting stealth rally, right? If you look at the Australian technicals here, despite all the negative moves, and I remember this also very clearly, this whole rate cut, negative employment, both spikes to the low in the 76s, and then we just pretty much stayed to the upside for the rest of the month. And it's kind of interesting to take a look at this month and see that we refused to come back and test those lows, even though next week we have the RBA rate cut, a rate decision, which many people are predicting to be a rate cut. So it'll be interesting, actually, to me, it's not so much what the RBA does, it's going to be the reaction of the Aussie. If the RBA cuts and the Aussie really doesn't suffer much of a decline, it's really a potential here for further upside because it would suggest maybe that the RBA is done cutting. The market thinks that most of the loosening has occurred, and it would provide us, ample room still to the upside as the carry trade still stays in the Aussie. For now, if you're looking at this technically, the higher lows, really continue to dominate this move, and it still continues to be an uptrend. Now, conversely, what would turn this negative? The break of the 77s. If we break 77s, we now basically have a distribution bottom, still not a fully negative structure, but a structure that then just cries for a test of the 76s. So really need to be watching this very carefully. If we break 77s and more importantly close below 77 on a closing basis, that would be a much more negative construct than what we're seeing right now. And then lastly but not leastly, let's take a look at the Kiwi. Another thing, by the way, market really rumoring that the RBNZ is going to cut rates. That's actually, I think, in some ways would be a bigger surprise. There's a sort of a 50-50 expectation they will. If they do, there's no doubt that this is going to be a topping formation, and the Kiwi probably goes to the downside, maybe even down to the 74s. If they don't, this actually really provides a really strong jump board to the upside. And in many ways, I think the trade that we were very, very bullish, the short Aussie Kiwi trade, had a squeeze retrace against us, and now we're back to the 103s. So we get a situation where RBA cuts and RBNZ does not, then you really have potential here for the Aussie Kiwi to go to parity. Not maybe this week, but as an ultimate terminal point. So in many ways, that could be the more interesting trade on the COM dollar side. as we get into the middle of the week. Wishing you guys the best of luck, the best of trading. This is Boris Lonsberg over and out.